Live from New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, pricing in more Fed action, gearing up for the ECB to hike rates as the BOJ refuses to throw in the towel. We begin with the big issue, a global bond market rout.
We are in a bond bear market, that's for sure.
There's a global bond sell-off.
The Fed officials are coming in with more and more hawkish talk.
The Fed's being forced to get more hawkish.
The market's priced in an awful lot.
4 50 basis point hikes priced in there.
Now suddenly 75 basis point hikes are being talked about.
They're pricing in a very aggressive pace of rate hikes.
The Fed isn't able to catch up to the market narrative.
The yields keep going higher.
Everything that moves long end of the Treasury curve is starting to move higher.
But growth is weakening. It is weakening all around the world.
We're seeing slowdown in global economic growth and tightening global liquidity all at the same time.
We may get a policy mistake, an even bigger policy mistake.
Joining us now to discuss is Goldman's Lotfi, Karoui, PGIM's Robert Tipp and Winnie Cisar at CreditSights. First to you, Rob. I was thinking of you earlier this week. Robert Tipp, are you a buyer of Treasuries yet?
You know, we're in the middle of the cycle here, as best we can tell. You're at the point where, the market has gotten way ahead of the Fed, and typically there's consolidation. I'll tell you, the one thing that is different, though, than it's been for 40 years is this level of growth and this level of inflation. We have accelerated in terms of job creation, and the inflation numbers have broadened and been sky high. And that combination is higher than it was in 2000. It's higher than it was in 94. The peaks of the last two 6.5% Fed funds rate cycles. So we're going to have to see if this pace of growth is not dented by this first handful, the next handful of moves by the Fed. We may be in the middle of the route, not the end.
Winnie, the conversation we're having at the moment over the Fed is the speed at which we get to neutral at. Is it by 50 basis point increments, maybe even 75? Nomura talked that up. They're looking for a 50 basis point move in May, then 75 in June, 75 in July. Winnie, I'm trying to have a bigger debate about the ultimate destination. Have you changed your thoughts on where that ultimate destination is, the peak of the Fed funds rate in this rate hiking cycle?
We haven't necessarily changed the destination. We are still a little bit lower than the market is pricing in, at least for the next 12 months or so. But we are changing the pace, just like the broader market is pulling forward rate hiking expectations. The Fed is threading a very narrow needle of trying to tighten financial conditions while inflation is still running very hot. And similarly, before we've seen the big downdraft in terms of the pace of economic growth, which is likely to materialize in the second half of this year and into next year. So the Fed has very little wiggle room in terms of timing to kind of get to that destination, which we ultimately think is not going to be as high as the market is currently pricing.
Lofty, your view, you think there's a narrower path for a soft landing here. Why has that view changed over the last few months?
I think it's changed because, as Rob was saying, this time is different. I think you're in a situation where you have a hiking cycle that is potentially the most aggressive we've seen since the mid-90s, and an economy that's already at full employment. And so the job of the Fed is essentially to figure out the right dose of monetary tightening that should slow down the economy back to trend, rebalance the labor market, but at the same time avoid a situation in which corporations essentially start cutting the workforce, and arguably that is a lot narrower as a path than only a couple of months ago. What's interesting is that when I look at credit, which is an asset class I look at very closely, the magnitude of the widening in spreads just doesn't seem right relative to the risks lying ahead, and that's one of the reasons why we think the direction of travel for spreads on a forward basis is still wider as we continue to build up more premium as a compensation for these risks.
Lotfi, you've characterized this through the year as a tug of war between a strong micro and challenging macro backdrop. Why is it the latter that's got the upper hand now?
I think up until now, you're absolutely right. I think the strength of balance sheet fundamentals have had the upper hand, on a challenging top-down macro picture. The other thing that I would not underestimate is really the power of negative real yields, because the other anchor, I think, that has allowed spreads to be fairly resilient up until now is the fact that the entire term structure of real yields has been very negative. That is about to change because as much as I think that the risks are a little bit more balanced for nominal rates, certainly relative to the last 3 months, I do think that risk is still skewed to the upside for real yields. And that's where you're going to test a little bit that new tug of war. So that's for the the macro, I apologize. From a micro perspective, we've also seen a clear shift, particularly among higher quality companies, a move away from, call it balance sheet repair mode, into more appetite towards active forms of shareholder friendliness, whether it's buybacks or M&A. And so even from a micro standpoint, there's more willingness, I think, to pivot away from a bondholder friendly posture into something that is a little bit friendlier to shareholders.
Winnie, can I just turn to you on the similar theme, just on positive real yields? Briefly on a 10-year this week, it didn't last for long. Is that something you anticipate is going to build up again?
So we are expecting that the 10-year is going to start to plateau a bit in kind of the latter months of this year. Our official forecast is actually that the 10-year Treasury is going to close the year a little bit lower. So we're not necessarily a big believer in kind of this positive real yield story playing through for a long period of time. And that's driven in part because of our more kind of dovish Fed expectations with a real pull forward of activity sooner rather than later and a kind of plateau off.
Robert, Tipp, to come to you on Treasuries as well. This week, the 2-year yields had a move of 25 basis points, at one point more than 30. That's got everyone's attention. The Federal Reserve and Chairman Powell talking up a 50 basis point move in May. That's got everyone's attention. Nomura talking up 75. That gets your attention too. Robert, Tipp, what people aren't talking about enough, I don't think, is the fact that break-evens have picked up in the face of that conversation. What explains that for you? Robert, what's going on there? Why are we talking about a more aggressive Federal Reserve at the same time in the bond market we're looking at break-evens breaking out again?
Yeah, I think, there's a creeping realization coming into the market that the growth is actually more durable. Some of the statistics have been changed ex post starting early in February with the revision of the payroll numbers, which had been showing a decelerating pace of job growth. Those were revised to a flat, very high level of job growth. The job growth has accelerated this year. The commodity prices have remained strong. The Russian invasion of Ukraine happened at the very end of February. The impacts of that have yet to come through. So when you compare this with the mid-90s or 2000, again, this rate of growth, job creation, inflation is head and shoulders above those levels. So when Powell comes in and basically, if he had just said, yeah, I could see doing 50 basis points, that would have been one thing. But he emphasized, yes, it's better to go early, and that there was a window open for a number of 50s, I think was the subliminal message that came out of this. This is a totally different cycle than last time when we did a series of 25s. Bigger moves are on the table for this cycle. And, when the market reflects on that, they see that unless you get an attenuation of the rate of growth, an attenuation of the rate of inflation, this Fed has room to go. And that's why you're seeing continued movement in the front end.
So, Rob, how does that shape your thoughts about the longer end, the relationship between the front end and the long end and the shape of the curve? Because if we'd had this conversation at the start of the year and I'd said, because I had a crystal ball and could predict the future with precision, that this was going to be the conversation going into May in the May meeting, I would have anticipated a conversation about a flatter curve, an inverted curve. But in the last month, given everything you've just said, something else has been developing here, Robert. And I just wonder what you think the relationship is between this rate hiking cycle and how the long end shapes out.
Absolutely. And if we were doing this in January or the end of last year, it looked like that soft landing was already beginning to play out. But at this point, it looks like you're still in kind of a full steam ahead. And even in Europe, I think some underlying signs of growth are stronger than people had expected. So when does the curve get flatter than what we're looking at right now? It's incredibly unusual. It's usually after the Fed has hiked rates a lot, like in the late 70s or at the end of 89 when they were at 9 3/4 on the funds rate. And it was clear you were headed into a hard landing. That's when you get the big 5s, 30s inversion on the yield curve. That's not where we are. We're more at a place in the cycle where the Fed is getting ready to move, the market expects to move, the market is pricing in a soft landing, and therefore the long rates are by and large, to the extent that we get a continued rise in the front end, they're going to keep pace with those increases in the back end. It's very unusual to get, say, the 5-year, the 30-year part of the curve much more flat or inverted than what we've seen lately.
Rob, if we go from central bank to central bank, and let's just finish on this segment here. If you take the Federal Reserve, you believe there's a green light. If I look to the ECB, there are movements to hike interest rates. At the same time, there's some real concern about what's happening in China. So perhaps they're constrained to some extent. Then you've got the BOJ, who does not want any part of this tightening effort of the Federal Reserve or the unwind of QE from the ECB. How sustainable do you think that is, Rob?
Right. So the Bank of Japan and in China, they have low inflation and they have a growth picture that they want to boost, if anything. So the Bank of Japan is fighting to maintain this 25 basis point ceiling, and they're clearly looking like they're having a hard time capping the yield on the 10-year JGB at 25 basis points. I'm not sure how that's going to play out, but I would think the odds are in their favor. I think in Europe, it's going to depend on whether the energy supplies get cut off or not, or whether they shut off the purchases of gas from Russia. If that happens, you're in stagflation immediately in Europe, and that's going to change their calculus. But if energy keeps coming into Europe, they may have a good ongoing growth, and they may be in a situation that is not that different from the Fed in the sense that inflation is well over target, the growth picture is good, and they end up moving, assuming that growth momentum continues.
Robert Tipp sticking with us with Winnie, Cisar and Lotfi. Karoui. Coming up on this programme, the auction block. Up next, the big banks driving high-grade issuance past $50 billion after earnings. That conversation up next. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction blog, where we kick things off over in Europe. The Easter holiday week rounding out with the lowest 2-week volume this year. Financials dominating sales and pricing nearly 90% of weekly volume. In the US, the big banks driving high-grade issuance with sales exceeding expectations and pushing past $50 billion. Bank of America pricing the biggest sale of the week so far. And the junk bond market heading for a third weekly loss, pricing just $900 million in the slowest April, going all the way back to 2008. Weighing in on the credit market, JP Morgan's Bob Michael making the case to buy.
Emotion tells you to hate credit. It's in free fall. But you have to appreciate the repricing that's happened. That combination of wider credit spreads and higher yields means you're not buying high yield below 5% anymore. You're buying it at close to 7%. You're not buying investment grade at 2%. You're buying it at close to 4%. I'd rather take advantage of the repricing in credit.
That's one view. Let's get to Winnie, Cisar for another view. Winnie, do you share that view? Have we repriced enough sufficiently to make you a buyer?
Well, we did re-rack our recommendation on investment grade back to a neutral. We had started the year underweight, and we are looking at a much more attractive carry trade in IG than definitely to start the year. As Bob pointed out, valuations have widened out pretty significantly, both from a spread and yield perspective, and at north of 4% for IG, that feels like a pretty attractive carry trade. But being a bit more mid-cycle, you have to be very specific in your sector selection, where you want to be on the curve. You don't want to be out swinging for these really big compression trades, just as you have a macro picture that's shifting so significantly.
Lotfi, I know you're on the other side of the trade. You've alluded to that in the last 15 minutes or so. Build on that for us. You've talked about this repeatedly, that credit quality is past its cyclical peak. Typically, when you pass that in a cycle, what does the pricing look like? How does that develop in the months, quarters, years after that point?
Well, so I don't disagree with this idea that the level of yield support in credit markets has improved. No question about that. IG yields, for example, are above 4% for the first time since 2018. Where I think there's room to further reprice is on the spread side. To answer your question about credit quality and how does that basically have an impact on index performance, it's not so much an impact that will be visible for headline spreads, but I think it's generally a catalyst for more dispersion across, names or sometimes even sectors. And that's been the other big theme, I think, this year, even though it doesn't feel that way when you look at the modest repricing in spreads that we've had. The amount of dispersion or differentiation in returns that we've seen has picked up quite materially, in my view. And a lot of that reflects shifting capital management priorities at the issuer level. I think that's something that will persist as the business cycle and the credit cycle both continue to age.
Lotfi, I was looking at where some of your underweights lie, and it's pretty broad across IG and high yield, but there was this comment there on the consumer, and I'm trying to work that out. I looked at the data in the UK today that came out this morning. That was really challenging. The consumer looks like it's getting hit around by higher inflation. Is that something you're looking to maneuver around within credit, within high yield, the companies, the industries exposed to that consumer?
You're right. We're underweight consumer retail for two reasons. One, we are concerned a little bit about the prospect of real income growth for households. We think the best is probably behind us at this point. And then there's a liability side to that equation, which is supply chain disruptions. I think the jury is still largely out as to the full ramifications of the Ukraine-Russia conflicts. Retail and consumer looks particularly vulnerable to us on the supply chain side, particularly given, at least by and large, the relatively weaker pricing power relative to some of the other more defensive sectors. And so that's really the main reason why we move to an underweight allocation on consumer retail.
Robert Tipp, where are you? Are you on the more constructive side with Bob Michael or the less constructive side with Lotfi?
Yeah, I think you've hit the range-bound stage, and I think there is risk in the market. Clearly, the tone in credit is soft. The issuance having to get pulled back on the high-yield side, because as the rates go up, money moves out of the market, and that dampens the liquidity on the spread markets, and they're hit disproportionately, pushing out the spreads. Even though arguably the fundamentals, they may be past the peak, but they're still pretty solid. So I think what's typical at this point in the cycle and what we're seeing here is that there are some taper tantrum strains that push spreads out temporarily, and then you go into a range. So I think we're going to be range bound for this first 2/3, say, of the rate hike cycle until we get to the part where we can see if it's a soft landing, hard landing, or otherwise.
Winnie, can I get a final word from you just on whether QT is a factor here in your thinking? Bob Michael pushed back against that. He said that 2018 was less about QT in the way some people think and more about the trade war that went into 2018 and pushed us towards a recession fear at the back end of 2018. Where do you lie on QT and market pricing of credit at the moment, Winnie?
I think that QT is definitely a consideration that we need to keep in mind. But when you look at how some parts of the market have repriced, particularly MBS, it's been a pretty significant shift as the narrative around QT, the information that the Fed has been putting out has been a lot. They've provided a lot of guidance in terms of how they're thinking about what they want to do, not necessarily the specifics, but I think investors are pretty well anticipating a May announcement as soon after that commencement of QT and kind of understand the mechanics. This is not the first go around in a QT program. Now, that being said, I think it is a mistake to say, oh, it's all priced in, everything is fine, because like in 2018, you have these macroeconomic complications that could ultimately weigh on fundamental expectations. And if the Fed is consistently pursuing its QT program while at the same time you have this erosion of fundamentals in the US and globally, that could definitely be problematic for spreads. So I would say that in general, we're expecting kind of this pattern of wider wides and wider tights in the IG market. But on a yield basis, things are looking much more attractive even when keeping QT in mind.
Lotfi, final word on that QT dynamic.
Yeah, look, I don't disagree with Winnie. I do think that when it comes to QT and more generally the stance of monetary policy, the interaction of that with the broader economy is ultimately what matters. We actually like some parts of the fixed income space that overpriced a little bit the QT risk premium. That's the case for the agency MBS market. We actually recommend that investors rotate into an overweight allocation on agency MBS versus IG credit, partly because we think that premium has gotten quite attractive, and we think the market is overpricing the likelihood of outright sales by the Fed of its agency MBS portfolio. But in general, look, it boils down to the interaction of QT and how the broader economy is doing in terms of the mix of growth and inflation.
And the QTF at this time around is so much bigger than last time around. Lotfi Karoui sticking with us with Robert Tipp and Winnie Cisar. Coming up on the programme, still ahead, the final spread, a busy week of earnings with big tech, the headline act. That conversation just around the corner. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. For those of you fed up of being whipsawed by Fed speak, I have good news. We're about to enter the quiet period. The final spread starts right now. The week ahead looks like this. Coming up, France rounding out its runoff presidential election on Sunday. Big tech earnings continuing with Alphabet, Microsoft on Tuesday, Facebook on Wednesday, Apple, Amazon and Twitter all on Thursday. A ton of numbers from the big tech names. And finally, another read on inflation in the United States and in the Eurozone as well. Europe's got some big problems on both the inflation side and on the growth side too. Let's get to the rapid fire round. 3 quick questions, 3 quick answers with Lotfi Karoui, Robert Tipp and Winnie Cisar. First question to the 3 of you. The Fed funds peak, a 2-handle, a 3-handle or 4+? 2, 3 or 4+? Robert Tipp.
I would say 3+.
Winnie.
2.
Lotfi.
3+.
Second question. High yield spreads from here, tighter or wider by year end? Just tighter or wider from here by year end? Lotfi.
Wider.
Winnie.
Tighter.
Robert.
Tighter.
Final question. As you look at the yield curve right now, your 2-year yield is 271. Your 10-year yield is about 290-ish, 291. I'm going to give you a choice. What finishes the year higher from here? The 2-year yield or the 10-year yield? What finishes the year higher from here, the 2-year or the 10-year yield? Robert Tipp.
2-year.
Lotfi.
2-year.
Winnie.
2-year.
To the 3 of you, thank you. Fantastic panel this week. Thank you very much. Winnie Cisar, Robert Tipp, Lotfi Karoui. From New York City, that does it for us. I'll see you the same time, same place next week. From New York, for our audience worldwide, this was Bloomberg Real Yield. This is Bloomberg TV.